Okay, welcome. I wanted to meet with you tonight. One, to go over week one and see how it went, and kind of tell you what I expected you were able to do after week one and two, to talk to you about what's going to happen in unit two. Unit one, you had a lot of things happen. You had the whole fiasco of the connect access codes, and I'm really sorry that that all happened. You know, this is the first running of this class, and sure enough, we're finding little bugs here and there. So I'm sorry that you had to be the guinea pigs and find some of these errors, but together we'll work it out. Please let me know if the school contacts you and gives you an access code. I am working with them and trying to make sure we have codes that'll keep you going throughout this course and the next course with access to connect. But I'm wondering if they won't contact you directly and let you know you have a new code. So please, if you get one, just pop me a message and say, hey, the school gave me a code, I'm all set. Okay, so what should you have learned out of chapters 1 and 2? A lot of stuff, unfortunately. One, I'm hoping that you have recognized account names, cash, accounts receivable, rent expense, accounts payable, capital, withdrawals. You have all these account names. You should be able to take any of the account names that you were given and classify them. Say, oh, that one's an expense. That's an asset. Oh, that one's a liability. That's going to be so important in everything we do from here on out, that as you learn an account, that you learn its classification. Because with its classification, it opens the door to everything else. So now you should know the classification. The classification then helps you figure out what financial statement something goes on. You have the income statement that has revenues and expenses, the balance sheet, the statement of owner's equity. Each one of those statements is important. You need to be able to prepare one. And each one has its own formula. So I'm going to show you an Excel spreadsheet here. Hopefully you can see on the screen. Let me see if there we go. You should be able to see the Excel spreadsheet. I have the financial statement formulas typed out. I am going to email or put this up in Moodle. So don't feel like you have to copy down what you see on the screen. The income statement has the formula revenue minus expenses equals net income or net loss. If the revenue is bigger than the expenses, you're going to have a net income. That's good news. But if your expenses are really big and your revenues are not so big, you're going to end up with a net loss. The balance sheet, you've seen that formula a lot. Let me shrink this down a little bit so we get more on the screen. And of course the phone rings. Hold on just a second. Okay. The balance sheet formula has another name. It's often called the accounting equation. And you can manipulate that accounting equation and show it lots of ways. The most common, the way you see it on a balance sheet, is the assets. They're usually on the left-hand side and all listed out. And then you have liabilities and owner's equity on the right-hand side. Those two are added together and the balance sheet shows that they equal each other. The assets are as much as the liabilities and the equity added together. But you can say assets minus liabilities equal owner's equity, or even assets minus owner's equity equals liabilities. The statement of owner's equity formula is a little longer, so I tend to write it up and down just because it would go on forever if I wrote it out horizontally. You start with the beginning owner's equity. Owner's equity at the beginning of the year, the month, whatever period of time. You talk about any investments the owner made to add to their equity, kind of like a bank would tell you deposits you made into your checking account. This is kind of the same thing, but for the owners. Then, the other good news that happens to the owner is if the company makes a profit, it increases their equity. Then the bad news, or the things that decrease the equity. And finally, end of the period, owner's equity. So you want to know those 3 financial statements and their formulas. So now if we talk about chapter 3 and kind of talk about what we learned in chapter 2, you learned the accounting cycle. The first thing we talked about was that a transaction happens. You had those in chapter 1. They give you a little sentence. Bought equipment for cash. That was a transaction. You had to analyze it, figure out what happened, think about what 2 or 3 accounts might be involved, whether the accounts increased or decreased. If increasing that account was a debit or a credit, then to process through all that stuff. But finally, you figured it all out and were able to write it as a general journal entry. That's called journalizing. You grab the general journal and write it out as a journal entry. Then after you put all your transactions in the journal, you posted them to the ledger accounts. Those were like fancy T accounts. You had a separate ledger account for every account the company has. So cash had its own spot. Accounts receivable had its own spot, and so on. So you get all the transactions posted, journalized and posted, so you know the ending balance in every one of those accounts. You move all those ending balances into something called a trial balance. And hopefully it balanced. If it didn't, you have a little investigative work to do to figure out what went wrong and what caused it not to balance. But those first 4 steps, we can highlight them all here. There you go. Those were chapter 2. That stuff hopefully seems familiar to you and comfortable to you. That's what chapter 3 is assuming. It says, now that you've learned that stuff, I'm assuming you're okay with all that. We're going to move on. That can seem a little fast. So make sure if you're still struggling with those first 4 steps, that we get it ironed out. So chapter 3 is going to adjust the accounts. That doesn't make a lot of sense yet, but they're going to adjust the accounts before they make the financial statements. So I'm going to take a little second and explain to you what it means to adjust the accounts. I'll scroll down here and give you a little story. January 1st, our company bought 2 years worth of insurance for $4,800. Well, that works out to $200 a month. They put the $4,800 in prepaid insurance, and there it sits. This account didn't get touched again because no one bought any more insurance. The other half of this entry, they would have debited prepaid insurance on the January 1st when they bought it, but they would have credited cash. I didn't draw the cash T account. I just wanted to kind of focus on what was happening in prepaid insurance. Let's say that it's March 31st and your boss has asked you to make quarterly financial statements. In other words, make financial statements as of March 31st telling how we did in the first quarter of the year. So the income statement would say, here's all the revenue we made in the first quarter of the year, here's our expenses, and so on. Our balance sheet just says the last day of the accounting period, March 31st, here's what we have for all these assets, these liabilities, and so on. So we'd say cash, only have this much. Accounts receivable, we have this much, and so on. Well, prepaid insurance, if we looked in the account, has $4,800 in it because nobody's touched it. I know I've got more stuff here. That's kind of what we're going to be talking about. But at that moment, nothing had been done. So this would say $4,800, which is not the truth. Because we don't want to tell our reader, March 31st, I still have prepaid for 2 years worth of insurance. That's telling the reader I have 2 more years left to go on this insurance policy. As of March 31st, I don't have 2 more years left to go on the insurance policy. I've used January, February, and March already. I've used them up. So I'd been misleading the reader, kind of overstating or inflating how much insurance I had if I left it at 4,800. So instead, I need to go over to prepaid insurance and drop it to the truth. The only way I could drop it, I can't go in here and just take an eraser to this account and change the balance, is I need to pull out 3 months worth of insurance. January, February, March. So I need to remove $600 because it's 3 months, $200 a month. $600 needs to come out of the prepaid insurance account. If I were to credit this account $600 with a debit balance of $4,800, they would work out to a final balance of $4,200, which would go here, okay? And then the balance sheet would tell the truth. But if I'm going to credit prepaid insurance, I've got to debit something. I can't just do a credit to some account without a corresponding debit. So I have an account, insurance expense. Now my plain English definition of expense is used up. So I would say that's the insurance used up account. Well, that sounds like a pretty logical place to put the $600 worth of insurance that we have used up. So what we're doing is we're pulling it out of prepaid insurance and dropping it into insurance expense. The general journal, we have to actually do this. This is the T accounts. This is our scratch paper to kind of go, okay, what do I want to do? Now I've sorted out what I want to do. I want to credit prepaid insurance and debit insurance expense. So I'll grab a general journal, put in the date, name the account I want to debit, name the account I want to credit, and how much money, and I've got a journal entry. That would get then posted to the ledger. As you're going through the chapter, you're going to find that these adjustments follow a pattern. Anytime you are asked to make the adjusting entry for prepaid insurance, you will always be crediting the prepaid insurance. So you'll be reducing prepaid insurance by the amount that has been used up. The amount will change at every story problem because everybody pays a different amount for insurance. And you'll always be debiting insurance expense for the same amount of money because you're moving $600 or whatever the amount is into the insurance expense account. You can start setting up some good notes. You've got a handout to help you do it, where you record the accounts. That way, anytime you read a story problem that says, please do the adjusting entry for prepaid insurance, you already know the name of the account to be debited and the name of the account to be credited. And then you have to just work through the story problem to find the amount of used up insurance. Sometimes they'll just give it to you in the problem, and sometimes, like this one, we needed to say 2 years worth of insurance, $4,800, that's $200 a month, and I've used January, February, March, okay, $600. So I had to do a little math to find that. Sometimes you're going to have to do a little math, sometimes it's just going to be given to you. Okay, so all those adjusting entries, you're going to learn a bunch more, probably about a total of 10 of them. So go to set of notes, 10 examples. That is what we're talking about here. You're going to make adjusting entries. You're going to journalize them, put them in the general journal just like this, post them to the general ledger. That means update the balances in all their accounts. And then do another adjusted trial balance. You did a trial balance before the adjustments, you're doing one after, just to make sure that in that process you didn't make math errors or debit when you should have credited and throw something out of balance. Once that adjusted trial balance balances and you're okay, then you can make the financial statements that are going to go out to all your people involved in your business. It might be creditors, it might be unions that are involved, might be government agencies, might be stockholders. Lots of people need to see your financial statements. And you want to make sure that everything's okay before you let them see it. So yes, it's a lot of annoying steps, but to make sure that we're telling the truth, because We all know what happens when a company doesn't make financial statements that tell the truth. They become a headline in the news and a case study like Enron that you'll see forever in business classes. So this stuff, prepare the financial statements, the adjusted trial balance, and the adjusting entries are all things that you're going to encounter in Chapter 3. Sorry, no way to highlight those. Maybe we can do this. Let's just kind of paint these guys different colors. So that's Chapter 3, doing those steps. Remember we talked about these up here. We're all Chapter 2, 1 and 2. And then we have 2 more, and these guys are all Chapter 4. I'll talk about those in a couple of minutes. The other thing we're going to learn about in Chapter 4 is that you can do a worksheet to help you do these 3 steps here. The worksheet does not take the place of actually grabbing the general journal and recording the adjusting entries and posting them to the ledger. It doesn't take the place of making financial statements. But it acts kind of like the T accounts acted. They helped us get our heads wrapped around what we needed to do. So that 10-column worksheet is going to help us do those 3 steps. So Chapter 4 is going to talk about that 10-column worksheet and then do our final 2 steps, preparing closing entries and making a post-closing trial balance. I know that doesn't mean anything to you yet. I'm going to explain it. And then we'll be ready to finish an accounting cycle and ready to start with transactions all over again. This cycle can represent a week, a year, a month, any period of time we want it to represent. But you will go through that complete cycle for each accounting period. So I think you have a pretty good handle on how to do Chapter 3. Obviously, you need to learn a lot more. Watch the lectures, read the lectures, read the book, practice the homework. Some tips I've got on the homework are going to sound a little weird, and they'll work for some people and they won't work for others. As you read the textbook, they're going to introduce each adjusting entry separately. I believe the first one they talk about is prepaid insurance, but whatever one they start with. You could go to your homework after reading and learning all about that one adjusting entry. Go skim through your homework and do every part of every problem that involves that one adjusting entry. You'll have probably done it 4 or 5 times. You're going to get a sense of it. You'll master it. You're like, okay, I can do that prepaid insurance one. And then you move on to the next one. There'll be an adjustment for supplies. And you can go through the homework and do just the supplies part of several of the problems. So you feel like you've got that one pounded in and work your way through the chapter that way. Accounting is awfully hard to sit and read a whole chapter at one time. It's too much to absorb. Generally, you need to read a section and then do something with it. Practice some homework problems. Do things so that that's part of it cements in, and then move on to the next section. In Connect, you should find an area that allows you to see hints, and there are probably some Learn Smart lecture things available in the resources or library that will help you concept by concept. So again, you may be able to watch just a mini lecture on how to do the prepaid insurance adjustment. So you can learn just one little concept, practice it. Learn another one, practice it. That way you don't feel like, wow, they threw 20 concepts at me and I'm totally lost. Hopefully that helps. So work on Chapter 3 and then move to Chapter 4 because, again, the concepts build on each other. You can't do Chapter 4 without learning Chapter 3. I'm going to give you like a mini intro to Chapter 4. But it's my hope that as you're going through this, if you get 3 taken care of or even get stuck on Chapter 3, contact me. We'll get that taken care of. We'll get you comfortable with 3. Then you can move on to 4. If at that point you're ready to listen to me and say, okay, I think I'm ready for you to talk to me about chapter 4, because when I watched it in the original lecture, it was just too much information. We could do that. You can sit down and just talk about chapter 4 after, or you could skim through this video and come back to the chapter 4 part when you're ready to talk about it. So, as you can see, the first green box of chapter 4 says prepare closing entries. What are closing entries? Entries kind of implies it's something you write in the general journal, because that's what we have referred to here. These are regular journal entries. These were adjusting journal entries. Now there's closing journal entries. A closing entry means to close out some of the accounts. And what does it mean to close an account? It means to make its balance 0. But notice this said only some of the accounts. The reason you only do some is because there are some accounts that you don't want to close. Just because you're at the end of the accounting cycle, let's say the end of the year, you don't want to close out your cash and make its balance 0. Can you imagine losing all the cash in your checking account at the end of the year, or being forced to spend it? I know if you're in governmental accounting, you might feel like that with your budget. But the whole government doesn't zero out their checking account at the end of the year. Now, this is my own personal favorite. Imagine at the end of the year if you could take your liabilities, all your debts, and wipe them out and have a party with them and just say, done. I'm zeroing them all out, starting fresh next year. That would be amazing. But I can see that the banks probably wouldn't be too happy if I did that with my mortgage, or the places I owe money, like the credit card companies or the utility companies, would not be happy if I just considered all my debts zeroed out. So practicality says you can't do this with all the accounts, but you can do it with some of them. So there are 2 kinds of accounts, and the lecture's going to talk about this and a whole lot more. There's permanent accounts, and kind of the way the title implies, you don't close these. Then you have temporary accounts, and those you close. Well, I can't spell for the life of me tonight, or at least type. So when we talk about closing entries, we're only talking about closing out the temporary accounts. The only problem is, except for the 2 examples I just gave you, cash and your liabilities, you don't know which ones you close and which ones you don't close. You don't know which ones are permanent and which ones are temporary. So here's a help. Permanent are any account you would find on the balance sheet. So you can ask yourself, would this account show up on a balance sheet? If it would, it's permanent and you don't want to close it. But if it doesn't go on the balance sheet, then it's temporary. So let's look at what the temporary accounts would be. You can't be assets because they're permanent. They go on the balance sheet. Can't be liabilities. They're on the balance sheet. Capital. Well, capital goes on the balance sheet. So the first thing I can think of is withdrawals. That's one that's temporary. Moving down through our categories, revenues and expenses. Those are your temporary accounts. And you're going to wipe out their balances. You're going to do it using 4 journal entries. And your chapter is going to explain each one of the journal entries to you. When you're all done, the only accounts that will still have a balance are your permanent accounts. All the temporary ones you will have wiped their balance out, so their balance will then be 0. So when I say prepare the closing entries, you're preparing 4 journal entries that will close out all of these temporary accounts. When that's done, you're going to make a trial balance. On this trial balance, you don't need to list every single account the company has. Some of them have a 0 balance. That would just be listing lots of account names and then saying 0. This one, 0. This one, 0. You can leave them off. Just list the accounts that do have a balance in them. So you'll see the example in the book that the post-closing trial balance is much shorter than the adjusted trial balance or the original trial balance. Okay, that's a lot of information to take in. So I'm going to stop here, upload this video, but I really hope you'll stay in touch this week. And if we need to have 2 or 3 mini meetings during the week to kind of touch base, make sure you're doing okay, I'd rather do that than just flood you with information. Okay, but my key is I need to hear from you. I need you to tell me how you're doing and where you're feeling lost and where you're feeling okay. Because it's my job to make sure you're not lost. And in the classroom, I can look at your face and see your eyebrows all wrinkled up and go, this isn't making sense, is it? And we could do it all over again. But I'm sitting at home with my ice machine next to me, which I'm sure you've heard through this whole lecture, and I don't have your faces. And I don't know if you're okay and bored, like, oh, you're explaining this just way too simply, and you know, you could go a lot faster. Or if you're thinking, would she slow down? And do that a couple more times, because one time just wasn't enough, and I'm so lost. So please help me help you. Hope you're having a good night. Hope to hear from you soon. And hopefully in a few hours this will be posted. It's about 8 o'clock on Wednesday night. And I bet by about 10 I'll have the video posted along with this worksheet that we've been playing with. Have a good night and let me know how you're doing.